Good morning, Mr. Ong. Today we'll be talking about Corporate Finance CA2 project, which is our school cafe proposal. So these slides are presented by Wen-Si, Richelle, Ruben, Raphael, and me, myself, Wei Shen. So for today's agenda, we'll be going through our real-world market research, initial cost estimate, cash flow forecast, weighted average cost of capital, capital budgeting analysis, and last but not least, our recommendation. So firstly, for introduction, for this project, we are determining whether opening a student cafe kiosk on campsite will make good financial sense and whether we will be able to profit after 5 years. For our real-world market research, we took Starbucks and Champion as our analysis. So Starbucks is an international brand. However, we took the details from a store which is of a place that is not as busy from downtown east. For Champion, it's more of a local brand, so we are able to see how much do locals actually spend in cafes in Singapore. So for Starbucks, the transactions per hour during peak hours is around 26, and during non-peak hours about 12. So the coffee price ranges from $5 to $5.10 to $9, and for the tea price it ranges from $5.90 to $8.90. As for the snack price, it's around $3.90 to $7.90. As for Champion, the transactions per hour is around 40 during peak and 15 during non-peak. The coffee price ranges from $4.90 to $6, and the tea price ranges from $6 to $6.30. For their snack price, they have a smaller range of $5.45 to $7.65. So where do our student cafe position itself? So for snack price, it's around $3.90 to $5.90, and we mainly sell muffins and croissants, which are easy to take away. As for the beverages, we mainly sell from $3.50 to $5.50. We mainly sell latte and ice blended drinks. As for transactions per hour, we took reference from our two real market research. However, we reduce both transactions per hour as we do not expect as much students to be buying from our cafe, especially since it's a school cafe. So our transactions per hour during peak hours is around 12, and the non-peak hours about 5. So our estimated peak hour will be around 11 to 1, where is lunchtime, and 3 p.m. to 5 p.m. when during afternoon time. Next up, we'll be talking about our initial cost estimate. Over here on the left hand side is all the initial cost estimate that we have accounted for, and over at the right side is a pie chart of the percentage of the initial cost. So for coffee machine and equipment, the brands of the machines and equipment are located on the left hand side. So we use a 2-group coffee machine to ensure service continuity, and one under counter fridge to allow our to store both food and milk ingredients to ensure freshness while saving space. Other equipment such as ice maker are also added so that operations can run smoothly. However, the high upfront cost may be a risk due to quality materials. However, there is a risk of a higher upfront cost in buying the equipment due to quality materials used, which may take longer time to recover. As for furnitures and renovation, the furnitures we used are mostly sourced from. As for furnitures and renovation, the furniture is mostly sourced from IKEA to reduce costs, and the renovations allows for professional finish and business to run smoothly. We mainly take the source for the renovation from different websites. The initial cost for both renovation and furniture are considered for cafe kiosks of around 150 square meter. For licenses and other initial costs, over here, the licenses that are listed are of a fixed price, which all businesses in Singapore have to apply for before starting. And for the other initial costs, they are essential to start daily operations smoothly. However, there is also a risk that licenses may take time for approval, which may delay opening. Next up, I'll be passing my time over to Richelle for the cash flow forecast.
Thank you, Ishan. Now we're moving on to my part on the cash flow forecast. So on the next slide, you can see we're talking about the timeline and operating calendar. So the project lifespan is 5 active operational years, and Year 0 is modeled as only a pre-operating capital expenditure, and at year 5, the kiosk will close and liquidate all remaining tangible assets. The kiosk will only open 200 days a year, and this correlates strictly with the operating calendar of Singapore Polytechnic, including some days of holidays, assuming students will be coming back to study before the term starts again. Now moving on to the next slide is the capital outlay and year 0 setup. The key assumptions will be the initial capital outlay is $38,431.20 that will fully extend in year 0. Now on the right side, you can see a graph that we created on tab blue is the net cash flow from year 0 to year 5. And then for the recoverable assets at year 5 will be the 20% residual salvage value applies to physical equipment and furniture. And the total salvageable value will be $2,658.36. And the 100% refundable deposits and / floats that we'll have is $2,150, and for the non-recoverable costs will be the leasehold renovations and regulatory fees like our licenses. And for the next slide, we'll be talking about the revenue, and the revenue here is the daily transaction volume. We will baseline the assumption to be at 100 receipts a day, 200 operating days per year, due to the localized peaks in morning lectures and lunch times and studying periods. And the average ticket size would be assumed to be $7 per customer, and each customer will maybe pick up a drink or a snack and a drink, so that's what we assume to be from our market research. And to calculate the revenue, it will be 100 customers per day multiplied by $7 per ticket multiplied by 200 operating days per year, and that will come up to be 140,000 at year 1, and it will increase year on year 5% due to the campus brand development and established customer flow. Now next slide, I'll be talking about our expenses wise. Firstly, our cost of goods sold, and the target margin will be fixed at 30% of the total operating value across 5 years. So the scope will be like our inventory, like our coffee beans, fresh milk syrup, big snacks, and takeaway disposals. And the year 1 base will be 42,000, calculated as the 30% of our year 1 revenue, and the growth scales automatically incline with the 5% annual growth. Moving on, I'll be talking about our next expense, which is our human resource and labor optimization. So we'll be hiring 1 full-time kiosk manager and 2 part-time student workers. So as for our full-time kiosk manager, they will work for us 9 months seasonal contract, and they will have $2,000 per month plus 17% CPF that we will provide. As for the part-time student workers, we'll be giving them $10 per hour, a coverage of 80 days per year, and that's per student. So total for 2 students will be $160 shifts at $60 per 6-hour shifts. And the operating schedule will be 200 days per year, and for both rates, for full-time and part-time, the rates will inflate at 3% per year, compounding from year 2. Now lastly, I'll have our overhead and operating costs. So our seasonal lease that I'll be talking about is a 9-month operating lease instead of 12 full months, since we only operate 9 months per year. So that would make more sense of us to be only paying 9 months of rent, $2,000 per month, and that would come up to be $18,000 per year. And the variable utilities that we have is year 1 estimate will be a $3,200, covering commercial espresso machine, oven, ice maker, and refrigeration. And the year 1 base cost repairs will be $1,000, licenses will be $495, consumables will be $400, and for the subsequent years, the current year expense will multiply by 1.03 based on the research Singapore annual inflation rate, which is 3%. Now that's all for my part, and I'll be moving my time to Raphael. Thank you.
Thank you. So for part 4, we first calculated the cost of equity using the capital asset pricing model, or CAPM. So the CAPM formula is cost of equity equals the risk-free rate plus beta multiplied by the equity risk premium. The table on the left actually summarizes all the inputs used in our calculations, which is the debt and equity weights, interest rate on debts, corporate tax rate, and beta were all provided in the project brief. Although the debt-related values are actually not directly used in the CAPM calculation, they will actually be required later when calculating the WACC. For our market-based inputs, we obtain the risk-free rate of 2.23 from the 10-year Singapore Government Securities Bond Yield published by the Monetary Authority of Singapore, as shown on the screenshot on the top right. We also use a Singapore equity risk premium of 4.17% based on Dawan's July 2026 equity risk premium data, as shown in the screenshot below. Using the project beta of 1.2, we then substituted these values into the CAPM formula, which therefore gave us 2.23% plus 1.2 multiplied by 4.17, which gives us a cost of equity of 7.23%. This means that shareholders will expect a minimum return of 7.23% for investing in a cafe project based on its level of risk. Now moving on to the next slide, we then calculated the WACC, also known as the weighted average cost of capital, which represents the company's overall cost of financing from both debt and equity. Before calculating the WACC, we first calculated the after-tax cost of debt because interest payments on debt are tax deductible. By using the formula RD multiplied by 1 minus the corporate tax rate, we calculated the 6% multiplied by 0.83%, which gives us an after-tax cost of debt of 4.98%. We then substituted all these values into the WACC formula, and since the project is financed by 40% of debt and 60% equity, we multiply the after-tax cost of debt of 4.9% by 40% and cost of equity of 7.23% by 60%. Adding these two components together gives us a WACC of 6.23%. Now the WACC is important because it represents the company's overall cost of financing from both debt and equity. It is also used to find a discount rate. It's also used as the discount rate when calculating the project's net present value or NPV in the next part of our analysis. Finally, it indicates the minimum rate of our cafe's project must achieve to be considered financially worthwhile. Now I'd like to pass it down to Wenxi to continue talking about part 5. Thank you.
Thank you, Rafael, and now I'll be presenting the capital budgeting analysis for our proposed campus cafe kiosk. As shown on the slide, the project requires an initial investment of $38,431.2 with forecasted net cash inflow starting at $44,245 in year 1 and increasing to $65,515.41 by year 5. Since the year 1 cash inflow is already higher than the initial investment, the payback period is 0.87 years or about 10.4 months. This means that the project can recover its initial investment within the first year. On the next slide, we are justifying why we selected a 5-year benchmark period based on 4 considerations. First, under Singapore's Income Tax Act, the prescribed working life for commercial plant and machinery is 5 years. Second, commercial F&B kiosks commonly operate under 3+2 year lease agreements. Third, commercial coffee machines and refrigeration equipment typically require major servicing or replacement after around 5 years of heavy use. Finally, capital budgeting guidelines also commonly use a 5-year evaluation period for small business investment. Moving on to the next slide, using our WACC of 6.33% as the discount rate, the project generates a NPV of $181,338.07. Since the NPV is positive, the project is expected to create value. On the next slide, the project has a IRR of 120.58%. As this is much higher than our WACC of 6.33%, the project is expected to generate returns well above its cost of capital. On the next slide, we explain why the IRR is high and why we also calculated the modified internal rate of return or MIRR. The high IRR is mainly due to the asset-light business model. The project requires a relatively low initial investment of $38,400 while generating strong cash inflows from the first year. However, IRR assumes that future cash inflows can be reinvested at the same rate of 120.58%, which is not realistic. Therefore, we calculated the MIRR using our WACC of 6.33% as the reinvestment rate. The MIRR is 50.7%. Although it's lower than the IRR, it's more realistic measure of the project's return. Since 50.7% is still much higher than our 6.33% of WACC, it shows that the project remains financially attractive even under more conservative assumptions. On the next slide, we tested how changes in customer demand will affect the project. Based on our assumption, the break-even point is 71.4 customers per day compared to our forecast of 100 customers per day. This gives a margin of safety of 28.6%, meaning customer demand could fall by nearly 29% before the project reaches its break-even point. In conclusion, the project has a payback period of less than 1 year, a positive NPV of over $180,000, and a MIRR of 50.7%, which remains well above the project's cost of capital. Based on these results, we believe that the project is financially viable and recommend proceeding with the investment. And now I'll be passing my time to Ruben.
Thank you, Wenqi. Now I'll be moving on to the recommendation segment of our slides. So, should the school proceed opening a school cafe? Our answer is to proceed. The four numbers tell us so. 180,000 in NPV, 120% in IRR, the 10.4-month payback period, and lastly a 50.81% in MIRR. So, here are the four reasons that tell us to do so. Firstly, our NPV is positive, and so we accept it. Secondly, our internal rate of return is 120%, which is much more than the 6.53% on our weighted average cost of capital. Next is our payback period, which is 10.5 months, which is less than a year. So, since it's less than 5 years total, we will definitely accept it. And lastly is our modified internal rate of return, which is 50.81%, and since it is greater than the WACC of 6.53%, we will definitely accept it. School recovers the full 80,000 and earns its return. Now moving on to the four reasons more into depth. Firstly, the NPV is positive 180,000 is created after the school recovers its full 38,000 and earns its return. Secondly, the IRR is a wide margin, and even if its cost of capital estimate is off, our gap is too big to change the decision. Thirdly, the capital comes back within 10 months, which is less than a year. Lastly, our MIR. The 120% IR may look too good because it assumes that you reinvest the profits at 120%. The modified IRR strips that out and is still 51%, 44 points above our cost of capital. Now, what if our WACC is wrong? Even at 20%, which is triple our estimate, the cafe makes over 115,000. The decision doesn't hang on getting the numbers exactly right. Now we'll be moving on to the business risks and how we're going to mitigate them. Firstly, demand is concentrated onto 200 business days. If the school goes online, there will be no walk-in trade to replace it. So we simply have to mitigate this by pulling demand from staff and evening classes. Secondly, price competition. The canteen will undercut us, and students are price sensitive. We simply have to compete based on our quality, loyalty, and combo pricing, and not being the cheapest. Thirdly, our operations. One espresso machine, one manager. If one fails, this will stop our best-selling line. We simply have to cover it with fast response service contracts and cross-trained relief staff. Now we'll be moving on to even more risk. Moving on. Firstly, rent. The 9-month lease is only an assumption. A 12-month could change our cost severely, so we have to secure in writing before committing any capital and rerun the test. Next is cost inflation. The coffee and dairy are very volatile as we model it at 3% a year, and spikes can hit our 70% margin directly, so we have to lock in fixed price suppliers and reprice the menu every single semester to mitigate this. Lastly, a food safety violation will not only affect the cafe's reputation, but also the school's reputation. This could result in less customers and result in fines. So we simply have to certify staff above the minimum and run regular hygiene audits. Now I'll be moving on to assumptions made. Firstly, we assume that a 9-month lease at $2,000 a month with no holiday rent. A commercial 12-month lease will cost around $25,000 of our NPV. Secondly, we assume that we will get 100 customers a day spending $7 each, which assumes that they buy a drink and a snack. Next is equipment. We assume that no equipment is replaced across all 5 years and the salvage is at 20%, as per the brief. Our last assumption is that there is no tax applied and there will be no charges for a school's admin or procurement. That is the end of our slides. Thank you very much.